Level 1. The spreadsheet. You close on the condo at 9:47 a.m. on a Thursday in March. The loan officer slides the papers across a conference table that smells like lemon polish and old coffee. You sign 47 pages. Your hand cramps on page 31. The down payment is $18,000, which represents 22 months of saving, 3 canceled vacations, and every birthday check from your grandmother since you were 23. The condo is 680 square feet in a building with beige hallways and a broken elevator. Your mortgage payment is $1,847 per month. You calculate it against your salary 5 times that night on the same spreadsheet where you tracked the savings. The number turns green when your checking account stays above $2,000. It turns green 11 months out of 12. You eat lunch at your desk now. You stop replacing clothes. Every faucet drip becomes an emergency. You read the HOA bylaws at 11:30 p.m. and learn you cannot paint the front door or install different light fixtures or hang anything on the exterior walls. You own it, which means you own 680 square feet of decisions you cannot make. Level 2. The inspection report. 3 years pass. The condo sells for $287,000. After commission, closing costs, and the payoff, you net $64,000. You buy a house in a neighborhood with sidewalks and trees that were planted in the 1970s. The house is 1,840 square feet. The inspection report is 34 pages long and describes problems with the foundation, the roof, the furnace, the grating, the electrical panel, and something called efflorescence in the basement. You negotiate $12,000 off the asking price. The problems cost $31,000 to fix over the next 18 months. Your mortgage is $3,200 per month now. You have a yard, which means you buy a mower, fertilizer, weed killer, hedge trimmers, a leaf blower, and a sprinkler system that breaks every spring. The neighbors introduce themselves by mentioning property values. Someone 3 doors down paints their house gray, and the neighborhood text chain lights up for 2 days. You attend a zoning meeting about a proposed duplex 4 blocks away. You hear yourself saying things about character and density. You recognize the arguments from meetings you used to mock. The house needs you in ways the condo never did. You spend Saturdays at hardware stores. You know the difference between load-bearing walls and partition walls. You cannot leave for more than 5 days without arranging for someone to check on things. Level 3. The second property. By year 6, you buy a second house. Not to live in, to rent. The numbers work if nothing breaks, and the tenant pays on time, and you manage it yourself. The house costs $340,000 in a neighborhood 40 minutes from yours, where the schools are worse and the grocery stores have security guards. You rent it for $2,100 per month to a couple who seem fine during the showing. The mortgage is $1,950. The margin is $150 before maintenance, property tax increases, insurance, or vacancy. The furnace dies in month 4. The replacement costs $6,800. The tenant calls about a leak under the kitchen sink at 10:20 p.m. on a Sunday. You drive over in the rain with a wrench and a bucket. The leak is a corroded pipe that requires a plumber and $830. You raise the rent to $2,250 when the lease renews. The couple moves out. The house sits empty for 6 weeks. You lose $11,700 that year on paper, which reduces your tax burden by $2,900. Your accountant explains this is a benefit. You list the house for sale after 19 months. It sells for $338,000. After commission and closing costs, you lose $24,000. You learn that real estate investing and real estate ownership are not the same category. You stop mentioning the rental property at dinner parties. Level 4. The refinance. You refinance your primary residence when rates drop to 2.875%. The monthly payment falls from $3,200 to $2,680. You take $85,000 in equity out of the house during the refinance. The loan officer calls it a cash-out refi and says people use the money for renovations, debt consolidation, or investment opportunities. You use it to buy another property. This one is different. It is a fourplex in a city 2 hours away where rent-to-price ratios actually work. The building is 94 years old. The units rent for $1,450, $1,450, $1,525, and $1,600. Total monthly income is $6,025. Your mortgage is $3,100. Property management takes 8%. Repairs average $800 per month. You clear $1,140 per month if nothing unusual happens. Unusual things happen every 6 weeks. A tenant breaks a lease and disappears. Another stops paying rent in month 8, and it takes 120 days to evict them through the legal process. You hire a property management company after the eviction. They take 10% now and handle the calls. You stop visiting the building. The management company sends monthly statements with line items you do not fully understand. The property appreciates by $67,000 in 2 years. You do not feel $67,000 richer. The number exists only in an appraisal you ordered to track the portfolio. Level 5, the portfolio strategy. By year 11, you own 4 properties. Your primary residence worth $625,000 with $185,000 in equity. The fourplex worth $520,000 with $180,000 in equity. A duplex you bought in year 9 worth $410,000 with $63,000 in equity. A single-family rental worth $385,000 with $71,000 in equity. Total portfolio value is $1,940,000. Total debt is $1,443,000. Total equity is $497,000. You track this in a spreadsheet that updates property values monthly based on Zillow estimates and recent comparable sales. The spreadsheet has 11 tabs. You meet with a financial advisor who uses the word leverage 14 times in 40 minutes. He suggests a HELOC on your primary residence to access another $120,000 in equity for your next purchase. The HELOC has a variable rate starting at 6.25%. You open the line of credit and do not use it immediately. It sits there as available capital. You attend a real estate investment seminar in a hotel conference room where 340 people learn about syndications, opportunity zones, and 1,031 exchanges. The instructor talks about mailbox money and financial freedom. You notice he is selling a course. You notice you already understand everything he is teaching. You notice the people taking notes are where you were in year 1. You leave at the first break. Level 6, the syndication. Someone you know from the seminar emails you about a syndication deal. An apartment complex in Tennessee. 148 units. The sponsor is raising $8,700,000 in equity. Minimum investment is $50,000. Projected IRR is 16.8% over 5 years. Projected cash-on-cash return is 7.2% annually. You read the 94-page private placement memorandum. The sponsor has completed 6 previous deals. 5 met or exceeded projections. 1 underperformed by 22%. And returned 87 cents on the dollar after year 7. You wire $100,000, half from the HELOC, half from liquidating index funds you have held since your late 20s. You receive quarterly distributions of $1,687. The distributions are classified as return of capital for tax purposes, which means they are not taxed now, but reduce your cost basis for when you eventually sell. You do not visit the property. You receive emailed updates with occupancy rates, rent growth, and capital improvement timelines. In month 31, the sponsor emails that a major tenant renewal fell through and occupancy dropped to 78%. Distributions pause for 2 quarters. The property refinances in year 4 at a lower valuation than projected. You receive $73,000 back on your $100,000 investment after the refinance. The deal is still open. The remaining equity might recover value, or it might not. You still receive the updates. You stop reading them carefully. Level 7, the accumulation point. You are 44 now. You own 6 properties directly and have passive investments in 3 syndications. Total real estate value across all holdings is $4,100,000. Total debt is $2,680,000. Net worth attributable to real estate is $1,420,000. Your primary residence is worth $890,000. You have lived there for 11 years. The neighborhood has changed. The coffee shop is now a wine bar. The hardware store is now a Pilates studio. Houses sell in 4 days. Your property tax bill is $14,600 annually. It was $6,100 when you bought the house. The increase is because the county reassessed values and because 2 school levies passed. You vote against the levies. They pass anyway. Your mortgage on the primary residence is $2,215 per month, which is below market rent for equivalent houses by $900. You realize you could not afford to buy your own house today at your current income. The rental properties generate $4,100 per month in net income, after all expenses, management fees, and debt service. This income is offset by depreciation deductions that shelter most of it from taxes. Your accountant describes your tax strategy as aggressive but defensible. You do not ask what defensible means in this context. You refinance 2 properties to pull out equity and buy another duplex. The duplex cash flows $340 per month. You spend 11 hours over 3 weekends analyzing the deal before closing. Afterward, you calculate the hours and realize you earned $30.90 per hour for the analysis work. You were trying to avoid earning a return that low. Level 8. The unrealized gains. At 49, you sit in your office and open the spreadsheet. Total portfolio value is $6,300,000. Total debt is $3,950,000. Net equity is $2,350,000. None of it is liquid. You own 9 properties directly. You have capital in 6 syndications. 3 are performing ahead of schedule. 2 are performing below projections. 1 stopped communicating 14 months ago, and you have written off the $75,000 investment mentally, though not officially. Your rental income covers expenses and debt service with $6,800 per month remaining. You pay taxes on a fraction of this because of depreciation. You calculate that if you sold everything today, after taxes and transaction costs, you would net $1,680,000. You do not sell. The properties continue to appreciate in theory. The equity grows on paper. You cannot buy groceries with equity. You take out another HELOC. Banks now offer you credit easily because the assets are there to secure it. You borrow money against assets you bought with borrowed money. Your debt-to-income ratio is 340%. This is fine because the debt is secured and the income is recurring. You explain this to your spouse, who nods but does not track the details anymore. The portfolio has become a system that runs itself through property managers, accountants, and automated payments. You check the spreadsheet every Sunday morning. The numbers change slowly and then all at once. A neighborhood rezones. A tenant destroys a unit. A syndication sells early at a premium. The market adjusts property values down by 11% in 1 quarter. None of these things require your daily attention. All of them affect your net worth by amounts larger than your annual salary. You stop thinking of real estate as something you do. It is something you are positioned within. The machine continues. Somewhere in another city, a 29-year-old signs closing papers on a 680 square foot condo and thinks this is the beginning of wealth. You know it is the beginning of permanent entanglement, with assets that appreciate, depreciate, generate income, consume time, create tax strategies, and never resolve into simple ownership. You have $2,350,000 in equity you cannot spend and $6,800 in monthly income that barely covers the additional properties you will buy, because not buying means the equity sits idle, and idle equity is inefficient. The spreadsheet updates. The values adjust. Tomorrow, you will review another deal.